Good day, Iggy. For today's interview series, I'd really like to dive into Singapore's latest energy developments with you. We've just seen some major announcements about clean power imports from Malaysia. It's a topic I know many investors are curious about.
Hey, Ivana, good morning. Absolutely. I'm happy to discuss this. As you know, I'm Iggy, and I've been covering topics like stocks, finance, CEF, and everything related to growing your wealth here at the Investing Iguana. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 60,000 likes. I produced over 1,000 videos with more than 600,000 watch hours as of August 2025. This energy development is huge for Singapore investors, especially if you're following companies like Semcorp Industries. Let me break down what just happened.
Perfect. So what exactly did Singapore announce on October 17th?
Singapore granted conditional approval to Semcorp Utilities to import 1 gigawatt of hydropower from Sarawak, Malaysia. Think of 1 gigawatt as enough power to run about 250,000 households continuously. This isn't just any power deal. It's clean hydropower that will flow through undersea cables stretching over 700 kilometers from Sarawak to Singapore. The project targets commercial operations around 2035. What makes this special is that it represents Singapore's first large-scale 24/7 power import initiative. Unlike solar power that only works during the day, hydropower provides constant, reliable energy.
That's fascinating. But why is Singapore going through all this effort to import power? Can't we just generate more locally?
Great question. Singapore faces a harsh reality. We're a tiny island with zero natural resources for power generation. We can't build massive hydroelectric dams like Malaysia. We don't have vast deserts for solar farms. Right now, we rely almost entirely on natural gas, which we import. Here's the problem. Singapore's power sector produces about 40% of our total carbon emissions. That's a massive chunk. As we push toward net zero emissions by 2050, we need cleaner options. Importing renewable energy from neighbors with abundant natural resources makes perfect sense. Malaysia has rivers and land for hydropower. We have the financial capability and demand. It's a win-win partnership.
You mentioned Semcorp Industries. How does this deal affect the company and its investors?
Semcorp Industries, through its subsidiary Semcorp Utilities, is the key player here. The Energy Market Authority gave them conditional approval after assessing that the project is technically and commercially viable. For investors, this matters because Semcorp is transitioning heavily into renewables. Over 60% of their capacity is already renewable. This Sarawak project adds another major revenue stream starting 2035. The company operates across multiple Asian markets with strong operating cash flow of $1.1 billion in the first half of 2025. However, the stock dropped 22% recently due to currency headwinds and weaker earnings. Analysts project earnings growth of about 5.6% annually over the next 3 years. That's decent, but slower than the market average of 9.4%.
So is Semcorp a buy right now based on this news?
Not so fast. The conditional approval is positive long-term. But remember, this project won't generate revenue until 2035. That's 10 years away. Between now and then, Semcorp must secure all regulatory approvals from every country the cables pass through. They need to finalize financing and complete construction. There's execution risk. For investors today, you're betting on management's ability to deliver this project while navigating current challenges like foreign exchange volatility and debt levels. The stock trades at a price-to-earnings ratio of 10.9 times, which is relatively cheap compared to most Singapore companies. But there's a reason for that discount. The market expects Semcorp's growth to lag behind. If you're a long-term investor who believes in Singapore's energy transition story, Semcorp offers exposure to that theme at a reasonable valuation. But if you need returns in the next year or two, this might not be your best bet.
Let's zoom out. You mentioned Singapore wants to import 6 gigawatts by 2035. Where does this Sarawak deal fit in?
This is where it gets really interesting. Singapore initially targeted importing 4 gigawatts of clean power by 2035. Due to strong interest from credible parties, they raised that target to 6 gigawatts in September 2024. The Sarawak project contributes 1 gigawatt toward that 6 gigawatt goal. Singapore has already granted conditional approvals and licenses for 7.35 gigawatts from various sources, including Indonesia, Vietnam, Cambodia, and Australia. If all these projects succeed, Singapore could actually exceed its 6 gigawatt target. Here's what 6 gigawatts means. It represents about 1/3 of Singapore's expected energy demand in 2035. That's a significant portion of our power grid coming from clean sources instead of gas.
I also heard about a second announcement regarding Malaysia. Can you explain that?
Yes, on the same day, 3 companies signed an agreement to study a new 2 gigawatt electricity interconnection between Singapore and Peninsular Malaysia. The 3 players are Singapore Energy Interconnections, SP Group, and Tenaga Nasional. This would be the second power link between Singapore and Malaysia. The existing one allows up to 1 gigawatt of bidirectional electricity flows. Think of interconnections as highways for electricity. They let power flow both ways depending on who needs it. During periods when Malaysia has excess renewable energy, they export to Singapore. During times when Singapore has surplus, we could potentially export back. This flexibility strengthens energy security for both nations.
This is a topic we've actually broken down with much more detailed charts and figures on our Substack. For anyone wanting to dive deeper, that's where you'll find the full written analysis.
Exactly. The Substack post includes comprehensive breakdowns of each project, timelines, and investment implications. Now let's talk about what this means for the average Singaporean investor beyond Semcorp. These energy developments signal a massive infrastructure build-out across Southeast Asia. Research from Rystad Energy suggests that if all proposed interconnections to Singapore materialize, they could unlock up to 25 gigawatts of renewable and energy storage projects worth more than $40 billion across the region. We're talking hydropower, solar, and offshore wind projects. Companies involved in construction, cables, engineering services, and power generation could benefit. Prysmian, the subsea cable maker, working with Semcorp, is one example.
You mentioned energy security earlier. Why is that such a big deal for Singapore?
Energy security means having reliable access to power at affordable prices. Singapore imports all our natural gas for electricity generation. When global gas prices spike, our electricity costs rise. We're vulnerable to supply disruptions and price volatility. By diversifying our energy sources through regional imports, we reduce that risk. If one supplier faces issues, others can compensate. Additionally, importing renewable energy helps decouple our electricity prices from volatile global gas markets. Over time, this should lead to more stable, predictable energy costs for businesses and households. For a small nation heavily dependent on imports, this diversification is crucial.
What are the challenges Singapore faces in achieving the 6 gigawatt target?
Several major hurdles exist. First, technical complexity. Building 700-kilometer undersea cables requires massive engineering expertise. These cables must survive harsh ocean conditions for decades. Second, regulatory coordination. Each project needs approvals from multiple countries. That involves navigating different legal systems, permits, and political considerations. Third, commercial viability. These projects require billions in upfront investment before generating any return. Financing such long-term infrastructure is challenging, especially with interest rate uncertainties. Fourth, geopolitical risks. Energy trade creates interdependence between nations. If political relations sour, energy supplies could be affected. Singapore mitigates this by diversifying across multiple source countries. Finally, timing. Most projects won't deliver power until 2030 or beyond. Between now and then, Singapore must keep the lights on while managing the transition.
How does this compare to other countries' energy strategies?
Singapore's approach is unique because of our constraints. Larger countries like the United States or Australia can build massive solar or wind farms domestically. Singapore simply lacks land. Our strategy focuses on becoming a regional energy hub. We leverage our financial strength, regulatory credibility, and stable governance to facilitate cross-border energy trade. It's similar to how Singapore became a trading hub despite having no natural resources. We connect buyers and sellers, provide financing, and ensure reliable operations. Other small nations face similar challenges, but few have Singapore's financial capacity to invest in such ambitious infrastructure projects across multiple countries simultaneously.
For our viewers who want to see the exact data you're referencing, where can they find those deeper insights?
All the detailed breakdowns, including project timelines, capacity figures, and investment analysis are available on the Investing Iguana Substack. We've compiled comprehensive tables showing each project, the companies involved, expected completion dates, and what it means for investors in specific stocks.
Iggy, before we wrap up, what's your ultimate take on this whole energy transition story for Singapore investors?
Here's my personal view. Singapore is making the right strategic moves. We have no choice but to decarbonize, and importing renewable energy is our best path forward. The 6 gigawatt target by 2035 is ambitious but achievable based on current progress. For investors, this creates a multi-year investment theme. Companies involved in renewable energy, power infrastructure, engineering services, and energy technology will benefit. However, most returns won't materialize immediately. These are decade-long projects. If you're investing in companies like Semcorp, you need patience and conviction in the energy transition story. Don't expect quick wins. Look for companies with strong balance sheets, proven execution capabilities, and diversified project portfolios. Also, watch policy developments closely. Government incentives, carbon pricing, and regulatory changes can significantly impact project economics. My rating for the overall energy transition theme, cautiously optimistic. The direction is clear, the commitment is there, but execution risks remain. For specific stock picks, do your homework on each company's financials, project pipeline, and management track record before investing.
Iggy, that was incredibly insightful. Thank you so much for breaking down Singapore's clean energy imports for us today. I certainly learned a lot, and I'm sure our viewers did too. Before we wrap up, for those who truly value this level of insight, what's the best way for them to stay ahead with the Investing Iguana?
My pleasure, Ivana. It's always great to discuss these crucial topics. For those who are serious about getting ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get my detailed analyses and urgent insights on market moves directly to your inbox, giving you a significant head start. It's just $3 a month, about the price of a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. If you're ready to join the inner circle and get that early edge, just click the link in the description below to become a premium member today.
Absolutely. Thank you, Iggy, for providing your insightful analysis. I look forward to our next video podcast.